Hi everyone, it's Chad about another video, and today I'm going to be talking about 3M stock. Please excuse the voice, I've just recently getting over a cold. 3M stock's had an absolutely putrid couple of years, down 50% over the past 5 years, down 27% year to date, but there's definitely potential here. This business is a dividend king with over 50 years of increasing dividend payments, currently pays a massive dividend yield of 6.7%, and just recently off its results, it's only just off its 52-week lows around $85. This is a business that not too long ago was valued at over $200, and I don't think it's that far away from this business with some good management and a good turnaround plan in action. But let's assess whether this is possible, assess the most recent results which caused a little bit of the bounce for the business, how the lawsuit issues are going, then look at its valuation, its past valuation, and what we think of this business. This report was just okay in my opinion. They largely met expectations with adjusted sales of $8 billion versus $7 to $9 to $8 billion of guidance. Their adjusted operating income margin was 23.2%. Again, lots of these being adjusted here. Adjusted earnings per share of $2.68 versus $2.25 to $2.40 guidance, and adjusted free cash flow of $1.9 billion. Now, lots of adjustments which we're going to talk about in a minute, which is obviously because the settlements they're expecting. But generally, a report in line with expectations is all we can really ask for. They're increasing the full year adjusted earnings to around $9 and adjusting free cash flow conversion from 100% to 110%. Now we'll talk about this a bit more later, but broadly I was pretty happy with this quarter from this point of view, from a point of view of expectations. However, the actual base numbers are not that impressive. When you look at the individual business segments, you see that in absolute terms this business is not really thriving at all. They reported adjusted net sales for a couple of them, but healthcare and consumer, interestingly, they didn't provide on an adjusted basis. Healthcare is about to be spun off, and that probably did the best of all of them, which is a bit disappointing. That was basically flat year over year. The rest of them were down between 2 and 7%. Consumer is struggling across the board, really, but this year they reported just over $8 billion in sales. And last year, they provided nearly $8.3 billion in sales for a minus 3% organic growth. Adjusted operating income was up 3.9%, but that was largely driven by transport and electronics with really strong demand from the automotive OEMs. Consumer was down 10%, which is really, really unimpressive, and healthcare and safety and industrial only slightly eked up from price rises. Adjusted operating margin as a whole was up 2%. Not that impressive, again, mostly driven by transportation and electronics. The whole strength of 3M as a business is its diversification, so take of that what you will. Consumer struggles, transportation and electronics increases. So on an earnings basis, I suppose they're increasing, but we don't want to be seeing a decrease in revenue at all. And then when you take away the adjustments and you just look at the absolute general accounting principles numbers, they're really unimpressive. Minus 3.6% sales growth, minus 4.1% gross profit growth. You can see across the board there's been real struggles here. An operating income loss of $2.6 billion, and it was a $4.1 billion profit the year before. Obviously, there's been some large charges that we're going to talk about in a minute, but a net income loss of $2 billion. So on an adjusted basis, these will kind of even out the lumpiness over the long term, but even still, this is money coming off the balance sheet. This is a loss, and this puts extreme pressure on what is now a 7% dividend. So I've been mentioning all these adjustments, and of course these were expected as a result of the Combat Arms settlement to do with the earplugs. It means that 3M will contribute a total amount of $6 billion between 2023 and 2029, which is under the structured agreement. It's going to be $5 billion in cash and $1 billion in 3M common stock. I think this is kind of a win for 3M. I thought it was going to be a lot more. There was rumours it was going to be $10 billion. I think that would have really, really hurt 3M in the short term. Basically, the nuts and bolts of it is they're going to record a pre-tax charge of $4.2 billion in the third quarter of 2023, $5.3 billion pre-tax present value contributions under the agreement, blah, blah, blah. 3M took a massive hit this quarter. It's not going to happen in the future. It's going to be a much smaller amount in the future. And then eventually 3M is going to return to profitability, because 3M is basically a profitable company. We're seeing this on the adjusted basis. That doesn't mean it's a thriving company by any means. We're seeing the numbers trend in the wrong direction. But 3M is not likely to go bust, in my opinion, and I think at the current price it's kind of pricing in that. Next, free cash flow. Again, caveats all over the place here because these are adjusted numbers. That's why they're reporting them, to make them look better than they actually are because of that massive pre-charge. But you would expect their cash flow is going to return to normal next year if they can get the ship steady, which I believe they are doing. So $1.9 billion of adjusted free cash flow. That was up 39% year over year. 4.3 billion year to date so far. That's up 37% year over year. They still have a ton of net debt, $10.8 billion, but that's coming down. That's down 11% year over year. And they continue to return capital to shareholders at a decent rate. $0.8 billion of dividends this quarter, no shares bought back. Year-to-date dividends, $2.5 billion. Now, you can see that dividend is quickly eating up a lot of its free cash flow. It's a very large payout ratio. I am concerned if future litigation happens or the debt is potentially high interest rate, they're going to struggle to pay down that debt. If it was me, I would cancel the dividend, even though it's a dividend king, take the hit on the stock price, buy back some shares on what I think are relatively cheap shares, and pay down your debt. I think this figure really shows how cheap 3M stock is, at least compared to its historical valuations. So if you forget about price to earnings for a second, because it's not currently earnings profitable, I guess, look at price to cash flow. 7.54 is currently its price to cash flow ratio. You look at where it's been over the last 5 years, an average of 13 in its absolute most healthy days, 2017, 18, 19. We're looking at 22, 19, 15, much, much higher than it is today. The S&P 500 trades at a price to cash flow of 15. This looks cheap on that basis. On a price to earnings basis, when it returns to earnings, it's probably going to be around 10 again. Its 5-year average is 17, 18. This is a dividend king that traditionally trades at a significant premium to the market. Even its 5-year average is below where the index is. For me, this offers a potentially really good earnings yield when it returns to earnings positivity, which it should do next year after that big adjustment. I think a lot of what was weighing down this business was the potential of these lawsuits to run up into the tens of billions of dollars, and it just doesn't seem like that's going to be the case going forward. I've talked about the dividend a couple of times already, but this is a dividend king. This is kind of what this business is known for. It's one of the most popular income stocks, and the reason for that is it pays a traditionally higher than market average yield. It increases payout ratio for over 60 years now, and it is generally beat the market over the longer term as a business. This is an extremely resilient business, seen as an all-weather business. That's not to say it hasn't had tough times, as it has in the past. Well, in the past maybe even 8 years, since 2015, the stock price has actually gone down since then. But over the longer term, this business has been an excellent stock to hold, and the dividend yield right now is the highest it's been for a very, very long time, the highest yield on cost for a very long time. Could it be reduced? Yeah, absolutely. If it was me, I was the CEO, I might well reduce it, but I don't think that's going to be the case, because I think they will be scared that it's going to take a massive hit on the stock price. And I think at the current payout ratios, they can just about afford it until they return to profitability. So I think that is probably what is going to happen. And I think the payout is going to increase maybe by a cent this year. Just that'll keep it edging forward to keep that aristocrat and king status. In addition to growing and paying out the dividend over the long term, they've also returned capital to shareholders in the form of repurchases. They've decreased the shares outstanding quite significantly just over the last 10 years, even when this business has not been doing as well over the last 5-8 years. They've decreased the share count from in 2013 from just shy of 700 million shares to now just shy of 550 million shares. Now, this is not the absolute most impressive decrease I've ever seen, but it's just good capital allocation, slowly decreasing the share count. I think they should be doing it even more, really. You can see a big increase in 2022, and that's because the share price has been low. I think they should continue to do this and capitalise while the share price is low. Overall, I think the best we could hope for with 3M is single-digit revenue growth, continue to pay down its debt, continue to pay out its dividend, repurchase some shares occasionally, and maintain its margins. I think that is absolutely possible and probably a reasonable case, in my opinion. I think after these adjustments are gone, they've paid off these lawsuit settlements, I think this business will return to reasonable profitability year after year. I do think it's a relatively all-weather business that's resilient, that's just faced some really tough headwinds in 2020 and 2021, and struggled to recover from them, and then was hit by 2 pretty big lawsuits that they're finally getting around to paying off. So I believe the significant headwinds are failing for this business, and it should return to normality relatively soon. I think from there we'll see significant multiple expansion, because this is still a dividend aristocrat. Well, it's not a dividend aristocrat, it's a dividend king. It's one of the most famous businesses for doing exactly that, just paying out its dividend over and over and over again and growing it every year. I think it can continue to do that as long as it increases its free cash flow, at least in the single digits, in line with revenue going forward. For me, I think it's tentatively, I want to say it's a buy right now for me. I'll be looking very closely. I think it could fall down a little bit more in the future because of the weakness in the market right now. But I think it has a relative position of safety, and it's already lost so much of its value. I don't really think it can go down anymore. I certainly don't think this business is going anywhere, so I think there's a little bit of a margin of safety developing here. That being said, I think the dividend could get cut pretty much at any time. Although while I don't think they want to do it, I think they could be definitely forced into it if some more headwinds develop. And I think that could be a really negative catalyst for this business. So I'm happy to wait and maybe squeeze a little bit more margin safety. Be really happy to buy under $80. Of course, this is just my opinion. You let me know your opinion in the comments down below. I'm not a financial advisor, so you shouldn't take any of this as personalised financial advice. Remember to do your own due diligence, and of course your capital is always at risk. Like and subscribe and enjoy the video. Comment your thoughts down below. I'll see you again next time.